So I'm going to ask our two bankers here about the different financial sectors and how they were impacted by the banking stress, and what's going to happen to the economy in these particular sectors. So I'll start with Mike.
Well, I think that probably this discussion needs to be qualified with what are our public policy leaders going to do in response to this, because they feel like they need to do something. So every time there's a banking crisis or banking stress, we end up with more regulations and more requirements, and that's been a dragging effect on the banking industry. In some respects, good, in a good way that it's helped improve risk management practices, but in other respects, it's stifled economic development. When George Morgan taught me, there was 30,000 banks in the country. Today, there's 4,500 banks in the country, and they're polarized generally in size. You have the mega banks, right? The city banks, Wells Fargo's, J.P. Morgan, and so forth. And then you have community and regional banks, banks like John's and smaller. And most of your closely held businesses and family held businesses bank with those smaller banks because they're in their community and they understand the business, whatever the unique attributes of it may be or the people may be. And so what we've seen structurally over that decrease in the quantity of bank charters, which historically was a strength of the U.S. economy, is that it's putting stress on the ability of small businesses to obtain access to capital. So our public policy leaders are talking about increasing capital requirements on banks, talking about increasing liquidity requirements and so forth, they're trying to diagnose this problem prematurely and come up with a prescription prematurely. And so my fear is that this is definitely going to contribute to the slowing down of the economy, whatever it is that they come up with. The truth of the matter is that as a result of the global financial crisis, we learned a lot about credit risk management, right? That was a credit crisis, and it was in isolated sectors. And what we did not do is adopt the same kind of credit risk management or risk management principles to deposit and funding risk. That is what really needs to be applied. And left to their own devices, bank leadership will figure that out. And they already have, a lot of them have known it for years, that we can't be over-reliant on volatile sources of funding. And so I think that the effect is there will be a further consolidation in the M&A, and unfortunately that's going to be negative for small and entrepreneurial businesses. The economy will be good, the banking system will be fine, but I hope that our public policy leadership doesn't go overboard.
I agree with Mike. The current stress testing for banks, which is much more extensive, the higher up the scale you go, is sort of fighting the last war. Bank stress testing generally contemplates the ability to stress the capital base of the bank to withstand the impact of credit losses. Yes, there's an interest rate shock concept, but nothing of the magnitude that what we just saw. Bank stress testing does not contemplate a run. For example, Atlantic Union Bank, uninsured deposits are in the low 30 percentage point. If every uninsured deposit in the bank left tomorrow, yes, we have the liquidity to cover that. We would be fine. If we sold every security in the entire bank tomorrow, we would still be well capitalized by regulatory standards. Not everyone could say that. So I think these are going to be sort of the stress tests that will now come into play. But they shouldn't go overboard as a result of a couple of fringe banks that were executing non-traditional strategies on unstable deposit bases and assume that that's true for the rest of the industry. It most certainly is not. I will say that all of this is going to back banks off from lending. The liquidity is getting tighter. Banks will be more cautious, and the industry will do some of the Fed's work for them in terms of slowing down this economy. which is not entirely a good thing. I call this credit rationing, Mike.
Yeah.
We're seeing anecdotal evidence now of banks refusing to lend in certain cases, particularly around commercial real estate. And I haven't seen this since the Great Recession. So credit will become scarce for a while. That will slow down the economy.